Liquidity is simply the fuel that drives the market. That means for price to move, there have to be liquidity in the market. Areas where retail traders tend to put their stop losses, or area where everybody is putting their stop losses, is that spot that liquidity is. And now it can be a buy side liquidity or a sell side liquidity. But the most important thing in this video is for you to understand the concept behind liquidity, types of liquidity, and most importantly, how to use liquidity to get a good stop loss, a good entry, and a good take profit. My name is Divine, and I want you to subscribe to this channel. I'll be right back. The concept of liquidity is based that price have to always sell before it buy, or price have to buy before it sell. Now what this means is that before every impulsive buy movement, there must be a fixed sell price action. That means price tries to create a scenario that looks as if price wants to sell, inducing people to come in to sell the market. And when they get enough people to sell the market, price then begin to buy. This is referred to as engineering liquidity. That means for every impulsive move, buy or sell move, there must be an engineering liquidity to induce buyers or sellers to sell the market, for price to do the opposite of what they're doing. Now for you to be able to understand or figure out these scenarios in the market, you need to understand liquidity, types of liquidity, how to look for liquidity, and where to look for liquidity. I'm going to be explaining the types of liquidity one by one in this video, step by step, for you to be able to understand liquidity. Now, the first type of liquidity you need to understand is support and resistance. As a retail trader or as a new trader, we always thought that you buy from the support and sell from the resistance. Now, there are people who have this idea that whenever they see a support, it's time to buy, and whenever they see the resistance, it's time to sell, putting their stop losses above every resistance and their stop losses below every support. Now, the main goal of this liquidity is to take out all the stop losses. Now, if you don't spot this liquidity, you often become the liquidity. Now, for you to understand this liquidity very well, you need to spot this liquidity and know where they are at the moment. Now, when every retail trader that have identified the support and resistance level and applied their stop loss and stop losses in the market, price will always take out all the stop losses and move to the opposite direction or to the right direction. Let's, for instance, see there's support here and there's a resistance here. When a new trader or a retailer comes in the market and see that zone, he believes that it's actually time for you to buy the market from the resistance to the support level. Now what he does is that he puts his entry at the resistance and puts his stop loss maybe 10 pips or 20 pips away from the resistance. Price will always move all those liquidities first before price eventually buy. So if you're not able to spot the liquidity, you eventually become liquidity. So the number one type of liquidity I've explained right now is support and resistance. Now the next type of liquidity for you to understand is double bottom and double top. Now every newbie as well have known that whenever they see a double top or a double bottom, it eventually means that it's time to buy or time to sell. Now when they see a double top, they tend to put their entry at the double top, with their stop loss the same thing, 20 pips or 25 pips away from the stop loss. Now price will always tend to take out that liquidity first before it continues. I'm going to give you an illustration by the end of this video, how to identify this thing on the chart and then use it to your own advantage. But before that, let's talk about the third type of liquidity. The third type of liquidity is often referred to as the Fibonacci level. Now, the Fibonacci tool is a tool that helps traders to know where price is going to retrace to continue a trend. That means it's often used for a trading market to know the point where price is going to retrace to. And it's often believed that price tends to always retrace to the golden zone, which is the 0.68 level on the Fibonacci. Now that spot attracts a lot of buyers and sellers to be at that point, putting their stop losses below that zone. So when the market is trending and you pull out a Fibonacci level to enter from the 0.68 level, price always does take out every liquidity below that zone. Hence, it becomes the liquidity. Now, the third type of liquidity I'll be talking about is the trendline liquidity. The trendline liquidity is very important because it can be on the higher time frame and on the lower time frame. Mind you, the first two types of liquidity I explained is often used on the lower time frame, but the third one I'm explaining right now is often found on the higher time frame, like the 4 hours time frame, 20 daily time frame, and most times 1 hour time frame. Now, the trendline liquidity often shows us that when the price make three impulsive move, price have attracted people to put their stop losses below every swing low that occurred on that trend. Now, when there's pools of liquidity at that level, price tend to take it off before it continues the direction. That means for every 3 impulsive move price make, price have engineered liquidity and must take out that liquidity before it continues. I'm going to explain on the chart. That means I'm going to use a chart to show you how to identify these levels or this type of liquidity in the market, if you watch the end of this video.
For you to understand how you can use liquidity to get a good stop loss, a good entry, and as well a good take profit, you need to understand market structure. Market structure tells us the direction of the market. Is it bullish or is it bearish? It shows us the change of character. It shows the break of market structure, and as well shows us the point of interest. I explained about all these things in my previous video, so if you've not watched it, go and watch it so that this thing I'm teaching here is going to make sense to you. Now, if the market is bullish, you tend to look for liquidity above the point of interest. But if the market is bearish, you have to look for the liquidity below the point of interest. Now, on my chart here, you can see that the market is bullish and we are going to identify liquidity below our point of interest. Now, the first type of liquidity on my screen right now is trendline liquidity. And I want us to study together how price induce sellers to sell from this zone here as early as possible and put their stop loss above this swing high, and this swing high here. Price created a price action that induced sellers to begin to sell early, and as well giving buyers hope that price is about to be bullish. Now, watch how here became bullish. Broke through this trend line here, induced buyers to put their stop loss below this place with the hope that price is going to be bullish, putting their stop losses below this swing here. So all these plays now have liquidity or stop losses everywhere. Now this whole place now becomes liquidity. That means price engineered liquidity at this whole level here. Now notice how price got to our point of interest and price dropped with full momentum, taking out all the stop losses that have been on this trend and taking out the sell side liquidity created by this trend as well too. Now, how do you know a valid point of interest? For you to get a valid point of interest, you have to see an engineering liquidity occurring below or above that point of interest. That is, for you to have a valid point of interest, there must be an engineering liquidity below the point of interest. Now, the question is now, how do you identify a good stop loss and a good take profits using liquidity concept or using liquidity? Now, if you want to get a good stop loss, the first thing you have to identify is to identify your point of interest. The next thing you have to look out for is the engineering liquidity that have occurred below that point of interest. Once you see an engineering liquidity occurring below the point of interest, it simply means that your point of interest is going to be valid, and the next swing, the swing high above your point of interest, is simply your stop loss. Let me show you how it is meant to be. Now let's assume you are entering from this point of interest here. Your stop loss should be above the swing, which is here. And your entry should be at the point of interest here. And now where should be your take profit? Your take profit should be the swing, the liquidity here, the sell side liquidity that I've already marked out here. So here should be your good take profit. So this is a very good 1:4 risk to reward. Now let's look at another example. Here I've already identified my point of interest and I can see a support and resistance type of liquidity. Why? Because at the resistance here, price always sells off. At the resistance here, price sells off to the support and buys to the resistance. At a point, you could see that price use a long wick to take out all the stop losses resting above this swing here. Because whoever is selling from this zone will definitely put the stop loss here. Now watch how price use the wick to take out the liquidity. But unfortunately, price did not touch get to the point of interest. So I would have taken this trade actually. Now look at this trend and liquidity. Notice how price made the first drop here and got to this level here. Got to this our demand supply zone created by the liquidity sweep. That will be for another topic. Now see how price got to this 1, 2, 3. And on the third move, price could not continue up and price dropped, taking out the liquidity, internal liquidity here. Now here could have been your entry for a good sell. Your entry could have been here, your stop loss above the swing high here. Your take profit now should be here. Now this is a good 1:2 risk to reward because we're able to identify a trend line liquidity. Now let's look at the next example I gave here, double top and double bottom. Now notice how I was able to identify my point of interest, and as well I noticed that there was a double top here and an equal highs here, and as well equal low, often called double top and double bottom. Now notice how price first of all took out double top and touched our point of interest and then proceeded in taking out our sell side liquidity. Now this could have been a good entry for me because price met my range. It took out the double top, touched my point of interest and went down to my double top where I have my sell side liquidity. So for a good entry here, my entry would have been here. My stop loss would have been this swing here above my point of interest. And my take profits would be at the sell side liquidity, which is here. Notice how price gave us 1:8 risk to reward. So if you're able to understand the types of liquidity in the market, know where to spot them, and know how to use them, you definitely have a profitable trade most of the time. But mind you, the most important thing is to know where to find liquidity. I explained to you already that if the trend is bullish, you should be looking for liquidity above your point of interest. And if the trend is bearish, you should be looking for liquidity below the point of interest. Now, if you are finding it difficult to understand what point of interest is, I advise you go back to my previous video where I explain all these things in detail for you to understand what point of interest is. I think this will be all for this video.